Welcome back. You're watching the life insurance special on Money, Money, Money. We've discussed term plans. We've discussed some of the savings products. Another important aspect of life insurance is retirement security, how to take care of your silver years. There are a number of plans that are being offered. Of course, life insurance companies also offer what is known as the annuity. So how does this product work? Let's ask our experts. So Rahul, your thoughts first on the sort of annuity schemes that are being offered and whether they really make sense for an individual.
Okay, so first I'll tell you the different kind of annuities which are there. There are primarily two kind of annuities. One is a immediate annuity and one is a deferred annuity. In an immediate annuity, you pay a lump sum today, and right from the next month or next year you start getting annuity. And a deferred is, you know, let's say you're 30 years of age, you choose that I want annuity from age 50, so you pay some premium till age 50 and then you know, you start getting annuity after age 50.
You get a monthly income,
monthly
then after
income
that,
or annual
age.
income after that.
Yeah.
Now, having said that, I'm not personally a fan of annuity policies because a couple of reasons. One, they do not offer too much of cover. So any product which does not offer too much of cover, I don't find, you know, it should be a part of life insurance, right? Second, from the tax perspective also, so life insurance, all the other products are completely tax-free, but in annuity only a certain portion is tax-free, the rest of the money is taxable, right? And third point, even the returns are lesser than a normal product. Right, because there are much more regulation, since you know it's more of a retirement kind of fund, so there are much more regulation which are attached to it by the government. Yes, the idea is for retirement, so you cannot play around with the money, but still, you know, I don't find it a very great product to be sold by the insurance companies.
So Harsh, again, if you're talking about the deferred annuity product, again, now here is an individual who will have to think, now I'm 30 something, I am trying to buy a product which is giving me life cover. Should I also buy a product which will start paying me back automatically? That annuity kicks in once I hit 58 or 60. Does that product make sense to you?
So if you take over from what Rahul said about the structure of the annuity, so you are say 30 for example, and you start contributing a certain amount every year. So that is nothing but an investment. Okay, this at the age of 58 or 60 when you're going to retire becomes a large corpus. As per the annuity rules, you're allowed to withdraw a certain portion of that, not the entire amount. Your money is locked in. So you're allowed to withdraw 1/3 of that and take it as a lump sum. Post which the balance amount is retained by the insurance company, and there are several different annuity options offered to you.
But let me stop you there and ask you a fundamental question. From the age of 30 today till the age of 58, every time that I'm giving money to, I mean, I'm just thinking in terms of wealth building or creating wealth, building a bigger corpus. Where is this money going? What form of investment is it getting invested in? Because I mean, I also have the option of putting a lot of it into equity and hopefully building a much better corpus.
Absolutely, you're absolutely right, because if you choose a traditional policy which is a deferred annuity, then the money goes in as per the formula which is given by IRDA. If you choose a ULIP based pension policy, in that also there is a restriction because you cannot take equity exposure beyond X amount, which is usually 50%.
Right.
So why? Because the money is being used for
for retirement safekeeping. So
the regulator has made it mandatory that you cannot invest the entire money into equity even if the policyholder wants it.
Even if you're starting young, even if you've bought that policy from 30 years onwards.
So ideally for a person who's young and wants to take that exposure into equities, 100% equities, then he should rather go into equity mutual funds, build that corpus on your own, and use it for whatever purpose. You can put it into a fixed deposit and get interest. You buy a property, get rent on it. So the rent that you get post retirement could be annuity for that matter.
Might as well look at active money management then, rather than sort of taking in these products. But anyway, gentlemen, some final thoughts and some important issues. Riders, the add-ons that I can attach to my life insurance policy. What are these options and are they sensible?
So there are quite a few riders. Most prominent amongst them are 3 riders. One is the personal accident rider, right? So where if anything happens because of accident, the family gets some more money. Right. Second is a critical illness rider, where again if any critical illness like a cancer or a kidney transplant or heart attack happens, then again you get a lump sum money, right? The sum insured for the critical. Third is a waiver of premium, right, which I mentioned about in children policy. If something happens to the father, the premium is waived, but the child continues to get the same amount of policy. Now, waiver of premium is, of course, a very good concept.
When you mentioned the premium waiver rider, which is available and it helps, so what sort of policies are we talking about? Because in the event that there is a demise, there will be a payout there and then.
So again, there are different kind of products in that. In some products, if something happens to the father, there's some money which is given to the family.
Okay.
In some products, there's no money is given to the family right away.
The policy continues.
The policy continues,
Okay.
no premium is paid, but money is given at the, when the child is 18 or 20 or 22, that time only.
Okay, okay.
We spoke about waiver of premium. So there's a dependent child. So if the insurance is on the child, on the life of the child, ideally it should not be. But in case you bought a policy in which the child is the insured, and the premium is being paid by the parent.
Oh, then you definitely need that waiver.
Yeah, so
just in case.
Yeah, in case the parent is not there, but the insurance policy is still active because it is on the life of the child.
Right.
So in that case, you need to take a waiver of premium.
Absolutely. And last question to both of you, the instructions or the tips or the directions that you'd like to give our viewers in terms of while they're buying the policy, doing the paperwork, making the disclosures, what can one do to make sure that you buy the right policy and get your claim settled, most importantly?
I think it's the most important point you have highlighted, because we see a lot of claims getting rejected because of some small you can say mistake, you can say wrong guidance by the agents. For example, let's say I'm a smoker, right? And if I click that I'm a non-smoker, and tomorrow if something happens, right, the claim can be rejected.
Because the company will find out. Invariably, the insurers find out.
Yeah, they do. Or for example, let's say I'm suffering from BP or sugar. Now these are conditions which can be suppressed, right, for a temporary period of time. So if I go for a medical and if I hide that I have sugar, and tomorrow if I have a heart attack and I die of sugar, my family would not get the claim, right? Or similar easier examples is, let's say, alcohol. Somebody who has alcohol, it may be even in small quantity, it's always better to disclose whatever is right, right? Even if the policy gets rejected, better it gets rejected. It's better than the claim getting rejected, right? A lot of intermediaries, agents, they will brag, don't disclose all this, otherwise your policy will get rejected, right? So don't fall into the trap, right? Absolutely, whatever is correct, be it good for you, be it bad for you, but it's very important to have 100% right disclosure in the policy to get the claim.
Harsh, final thoughts?
Well, continuing from there, so the idea is at the time of taking the policy disclosures, so it's all your disclosures need to be made, and that can happen only when you fill the form yourself. So as much as it may be painful and maybe I'm running into multiple pages, try and fill the form yourself.
Right.
Even if you don't fill the form, at least ask your advisor or your agent for that matter that after it is filled, show it to me before submitting it. So that's, you might not actually physically fill it up, but at least see it once before it is being filled. Even that is, if you're not even doing that, when the policy document comes in your hand, as per IRDA guidelines, the insurance company is supposed to attach a copy of the proposal form that you have filled in. So at least at that point in time, have a look at it whether all the disclosures have been made. Now, even if you've not done it within that period, then if your claim is rejected, then I think it is well deserved. Because there is no point in being so dependent on your intermediaries and not even giving that 5 or 10 minutes of your time to look into a document which has so much of financial implication.
Okay.
So that is one part. Now, after you get the policy in your hand, there is a 15 days grace period wherein you can go through the terms of the policy. Because we've seen invariably a number of cases wherein you have asked you've been rather told that this is a single premium, but however, when you fill the form, it has been made as an annual premium. So whatever you think has to be made, there has to be your single premium and no more commitment, it actually becomes your annual commitment for the next 20 years.
Right.
So just go through that policy documents, especially the schedule. The first page at least tells you what your entitlement is. And you may not go into the fine print if you don't wish to. But these are the basic hygiene elements that you need to take care of. Once you're done with this, then I think you should be safe.
Absolutely. All right, gentlemen, thanks so much for taking out the time. The takeaway is very clear. Be a little alert, be a little aware, spend the time to read that policy document. It could be a very, very critical document in your life. That's it from the team. Thank you so much for being with us on this week's episode of Money, Money, Money. Of course, we would always appreciate your response, any feedback or queries that you may have. Our email ID is on the screen.